Today, folks, we're talking everything utilities and renewable stocks. Whether you're flicking your lights on or turning your tap to get water, these are the companies responsible for that and have been one of the best plays for people looking to generate dividends, passive income, and cash flow where you can sleep easy at night knowing these utilities are going to be around for your entire lifetime. If this is a conversation you appreciate, in return, I simply ask that you hit that like button because we just got through a bunch of earning periods with my favorite utilities. So I want to look at two in particular where you're going to get to learn a lot about the in-depth information I'm going to share with you, and then we're going to look at another half dozen or so that I would honestly consider buying as well. But first and foremost, Algonquin Power and Utility Corp, ticker symbol AQN, is by far one of my favorites here, guys, with a dividend yield of 4.65%, which is where most people are going to fixate on. And just going straight into that dividend, guys, if we go back 10 years to 2012, the dividend payout per quarter was about 0.0775 cents. Skip to today, guys, and we're getting 0.17 cents. So that's basically over a doubling, which basically means if you bought it back 10 years ago and you were able to get a 4% dividend yield, skip 10 years later, your yield on cost is now 10%. That is the beauty of compounding dividend growth that we can get out of utilities like this. So what does Algonquin Power do? Well, they kind of have this diversification here that we're just going to take a brief look at, pretty much mixed between the US and Canada, with regulated services groups being electric 55%, which would probably be mostly transmission lines. Gas, they have a large exposure to natural gas specifically. Water utilities make up 11% of that income, and then 4% from other. Now, from the renewable energy group aspect of their business, basically wind makes up 64% of that portfolio, solar at 5%, hydro at 4%, thermal at 4%, and then Atlantica, not sure exactly what that is, at 24% here, folks. Now, diving into the recent earnings report and why utilities are very hard for investors to wrap their heads around, because let me lower my head so we can see this a little clearer, and let me zoom in a little bit, because when you go and look at their earnings, guys, when we take a look at the earnings before income taxes, basically they only did 142 million for 2021, which looks like crap compared to 2020 when they did 792 million. But like real estate, because this is a very costly investment that they have to make to build this infrastructure up, we can actually take a look at the revenues generated. This is where I primarily like to go, and then we're going to break down why they're losing so much money. Because from regulated electricity distribution, they went from 776 million to 1.183 million. Regulated gas distribution went from 454 million to 525 million. Regulated water went from 154 million to 234 million. Non-regulated energy sales from 255 to 264. And if we just take a look at basically the total revenue generated from 2020, when they only did 1.6 billion, this year in 2021, or the one that passed the whole year, is 2.28 billion. So they grew their revenues unbelievably. But when we take a look at the operating expenses, this is where things get a little finicky and interesting, because the operating expenses went up by 200 million. The regulated electricity purchases went up by about 200 million, guys. And where you really want to pay attention is the depreciation and amortization, because like buying a new car, guys, that car is still going to continue to operate, but the next year won't be worth as much, and you can write it down. That's what real estate investment trusts do, and that is what utilities do with these large capital investments in this infrastructure. So overall, guys, when we just take a look here, this is really good, because basically the depreciation and amortization is not the loss of capital. So if you just take that 402 million and you plop it on the income tax, the earnings before income taxes, that would take them up to what, maybe 640 million, give or take, and it would get them a lot closer to basically what they earned last year. And most of these are controllable expenses. So this is kind of the way you have to look at utilities, and know that like operating expenses, and they'll fluctuate based off what management wants to do to basically save money, because they're primarily just focused on paying dividends. So that's kind of the boring part of this segment, because I know many of you probably not as intrigued by earnings, but you should be, because basically the way we look forward with these companies specifically, guys, is the investments they're going to continue to make. And basically they're going to do 12.4 billion capital investment plan from 2022 through 2026. So basically between the regulated service group and the renewable energy split here, guys, it's a pretty large amount of capital investment, which should continue to bode well for the dividend increases as they continue to generate more and more revenue. I like these smaller utilities over the large ones, because this $12 billion market cap has a lot more room to grow with these capital investments, whereas the really large utility providers could invest 15 billion and it wouldn't even make a huge impactful difference on the bottom line for them. So that's why I like these kind of mid-tier utilities. My second favorite one by far is Northland Power here, guys, one that was literally one of the first stocks I ever bought 7 years ago. My yield on cost is a lot better than this. It's over 5%, but for right now the dividend yield sits at 2.94%. Ticker symbol's NPI here, and this one has also been trading down because based on their last year's earnings, it was very slow leading up to the last quarter, which we'll talk about in a sec. From a dividend standpoint, this one's not as fun. Obviously, you're probably just buying it for the monthly income, but historically this thing has never really increased its dividend except once in 2017 when they went from 9 cents to 10 cents. We haven't got a dividend increase since. But just taking a look, guys, this is basically the fourth largest operator globally for wind projects. So it's one of my favorites because it's Canadian first and foremost, and it has global diversification primarily in wind projects. And just taking a look at how their EBITDA breaks down from income, offshore wind makes up 52%, onshore renewables 24%. That'd be a mix of wind and probably solar. Efficient natural gas makes 16%, and general utilities, which are probably transmission lines, make up about 8%. And based off their last earnings here, guys, it kind of reignited my love for this company because, like I said, going through the first 3 quarters of 2021 was a nightmare for them. They didn't really do that well, but for some reason on the last quarter, they did phenomenal because from the last quarter in 2020, they basically only had sales of $492 million, but they bumped it on this last quarter in 2021 to $640 million. But basically for the year end from $2.06 billion to $2.09 billion isn't that drastic of an increase. But that's because they ran into some issues with their offshore projects in Germany. Obviously, this infrastructure takes some time and it's not nearly as cut and clean as most people would like it to be, but I love this company. I think they're going to continue to grow and do amazing. They have tons of projects still coming online. So if you're looking for monthly income, I think this is a great place that gives you access to not only what the Canadian pension plan is buying because they have a huge stake in Northland Power, but it also just gives you that global diversification in a sector that's going to continue to grow with the current cost of gas and many countries trying to become independent with their energy. Now, some honorable mentions, other companies I don't own that I would look at owning. One on my list right now, obviously Fortis, which I've talked about, which is a Newfoundland and Labrador-based international diversified electric utility holding company, operates in Canada, the United States, Central America, and the Caribbean. I mean, they've done very, very well for themselves with a starting yield of 3.55%. Another favorite of mine that I kind of look at now and again, but the Brookfield Infrastructure Partners, anything with Brookfield in the beginning of their name usually is followed by a pretty impressive chart. 5-year return on this guy is 84% just from a capital gain standpoint, and the starting yield is 3.62%. So basically in the last 5 years, you've equaled the S&P 500 returns with this company if you plot that dividend on in there as well. So Brookfield, awesome company. Now Hydro One, this is actually a new regulated utility because this was ran by the Canadian government and they spun it off to make it public basically back here in 2015 time frame where the stock really didn't do much for a few years and then it finally started to take off. This one is purely focused on transmission lines and that's about it. I think they do offer some like building products that have to do with generators in case there's power issues, but primarily this is a pure transmission line play, and I really like it because it's primarily controlled still by the government. They have the largest stake in it, so 3.26% dividend starting. Some pretty good growth so far, but in the last 5 years, it's up 41%. But let's talk about some of the U.S. utilities now, because I know a lot of you are U.S. watchers. You probably want to hear about some of these. Algonquin Power gives you some of that U.S. exposure. All of these companies kind of give you global exposure to some varying degree. But Southern Company here, guys, this one is really diversified, not as heavily in renewables right now. A lot of exposure to nuclear, transmission lines, the gas industry, water utilities like dams and stuff like that. This one in the last 5 years is up 36%, pays a 3.91% dividend yield, and is my personal U.S. pick that I'm currently holding for my U.S. pure utility exposure. And Duke would probably come in second at play here. This one actually has the largest exposure to nuclear power plants. Nuclear power plants are very costly to set up, but typically when those suckers are up and running, you get 60 years of income because they can't just shut down a nuclear reactor. But with a 3.74% starting yield here coming off Duke Energy, ticker DUK, and with Southern Company, the ticker symbol is SO. These aren't nearly as renewable focused. They're adding that as a segment, but for other basic exposure to general utilities, these are pretty good, I'd say. Now, one of the largest ones that some people mention, I've never bought it, but NextEra Energy is by far probably one of the largest utilities in the world, $157 billion market cap, and I'm really surprised at the growth this thing has had, because like I said, typically when these utilities get as big as they do, they have a harder time growing, but somehow NextEra has done a phenomenal job here, 146% 5-year return without the dividend. Wild stuff. Clearwater Energy, another kind of smaller cap one. This one I figured I'd throw up as an honorable mention because it has a 4.55% dividend yield. But, the 5-year return here, guys, still pretty feasible. The long chart, a little bit more rocky. I'd like to see why they fell off in 2015. But otherwise, for the cash flow, we're not really buying these for capital returns as much as we're buying them for that next 50 years of our life to generate passive income, right? And then finally, a pure water utility, Waterworks here, guys, American Waterworks Company, ticker symbol AWK. This one has had a 5-year return that's outperformed the market with a 1.5% starting yield, but this gives you pure exposure to water treatment facilities. This is personally why I like Algonquin Power the most, because it gives you that exposure to every different one of these segments, and I feel like you get the best diversification with it. It's why it's just one of my personal picks. But honestly, what you'd want to do here, guys, is take a handful of these companies, just go through them, make sure you're comfortable with them, and basically just make a portfolio of these utility assets. Because you're not going to go wrong. Some will outperform, some will underperform, but at the end of the day, you're going to be generating a 3 to 5% cash flow off these things. And honestly, guys, the most boring basically sectors of the market are the ones that usually do the best. If you're excited about your investments, typically you're not investing properly. So I really like this sector, and it's something I'm going to continue to add to my portfolio. And of course, I'll continue to update you here, guys, when I see the earnings come out and anything else that I find appealing. So consider subscribing for those future updates. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.